Welcome to the Accounting Play Podcast, to know your numbers and to know your business. How do I pay less tax? Should I be an LLC or S Corp? What is deductible? All of the above are a few of the most commonly asked questions we get, and business owners need to know, and startup entrepreneurs need to know. How do they get their taxes done? What is in it for the bookkeeping? And what are those 3 secret success factors? Listen on. Welcome. John Gillingham, CPA, here from accountingplay.com, where you'll find our master's course, Know Your Numbers, and be a client at gillinghamcpa.com. Today's a big day. I visited a client at Google. He's rich, and I suggest you work at Google as soon as possible. But he suggested, not completely unself-servingly, that we go on YouTube. And I think so. It's time that the YouTube channel be refreshed after a 3-year break so you can see who we really are and what we're trying to do. So you can find us at YouTube and let me know what you think, John at accountingplay.com. Disclaimer as always, get some real advice. This is educational. What I'm trying to do is give you the pointers that you need to research on so you can find a good person to work with and get to the value added point of tax advisory, paying less tax, and really having good information about your business. So in your business, you're going to have accounting. That's very important. Most business owners don't even have that on a monthly or quarterly basis. And you're going to have your KPIs, your key performance indicators. So one of those key performance indicators is what's going on with the expenses, what's going on with the revenue and income. Out here in San Francisco, it's wild. You know, they're not basing the business on profit. They're just wondering about users, et cetera, et cetera. But most people, we're going to want to know how much we're making, how much we're spending, who we're spending it on, whether it's that internet bill that doubled or your hosting, which tripled in our case, et cetera, et cetera. Skipping, wasting no time, let's get to the top 10 questions that people ask me all the time. I'm at a cocktail party. Oh, hey, I'm a CPA. And they say, number 1, how do I pay less tax? Well, I was told the 2-word plan once, how to pay less tax with a small business. And it's simple. That's right. Cash only. But of course, when you receive cash, you're claiming that on your tax return, right? That's right. All cash. Accepting cash and alternative payments is the first step to tax prison. You know, the IRS has a rather limited scope of what's really going on unless you're doing really, really bad stuff. So for all you tax sort of cheats out there, sure, lots of people, they'll scrap together $40,000 a year, 50 grand. Maybe they'll claim half of that on their taxes, but ultimately they're not left with much. They go to qualify for a mortgage and then they have no stated income to qualify on. And ultimately, you should be in a business that's making enough money where you can pay your proper share of tax after you get your deductions, put away for your retirement plan, and maybe sell this business someday. So, of course, the all-cash plan is a little bit of a joke, but that's the reality that I think a lot of small business owners are still on. So let's not be BS about it. So how do you pay less tax? You cheat. We don't advocate that. So do the right thing. Get a business plan that plans for how much tax there is. So oftentimes when I talk to a small business and they're at the $20,000, $30,000 range, right? You may be, taking our course thinking about how many millions of dollars you're going to make. But the reality is that first $30,000 of profit is pretty hard. And you're going to pay rather little tax. But the difference between $30,000 of self-employment income and $50,000 is big. So especially in San Francisco, high-cost areas, it's a huge trap for small business owners who make their first $80,000 profit, $100,000 profit. They're stuck with a $30,000 tax bill and nothing to pay for it. So just realize tax rates are kind of exponential, or really you have a really low rate at the beginning and then it gets higher. So you can accelerate your expenses in order to pay less tax in that case. Reality is, small business owners can pay tax by creating expenses. So people are spending on Amazon or their servers or whatever, and it's not uncommon that a business owner kind of accidentally pushes their personal expenses into their business. Now, how that's supposed to work is the personal component, as far as like a sole proprietor goes, you can take that out of the expense by putting that to a draw. And if you're a different business entity, there's ways of doing that. So you need to let your bookkeeper know what's personal. But the reality is, the business owner, as well as the big business, the Amazons, the Adobes, the Googles, they are trying to empower their employees to make as much of their personal expense, otherwise personal expense, as a business expense. So, for example, if you're just a regular employee making 50 grand a year, then you have to go pay your $100 a month cell phone bill. That's all after-tax money. That's very expensive. Whereas an entrepreneur will probably err to say that's 100% business. Now, of course, you can't do an allocation, say this is 80% business, etc. But the name of the game is lots of legitimate business expenses, and that is part of owning a business. You are allowed to deduct ordinary and necessary expenses. Boring. I know. No one wants to pay tax. From a long-term planning perspective, lots of businesses, they accelerate their expenses too much. So they say, I don't want to pay tax, so I'm going to go bonus out the employee. I'm going to get some more help. I'm going to buy some big piece of equipment that might help, but maybe is not that helpful in the end. Ultimately, I know it's boring, but companies need to make their profit, pay their tax, and then keep the difference. Terribly, awfully boring, but that is the reality for most businesses, being on the right side of the law and ethics as you understand them, of course. Don't go to jail. Once you're over $100,000 of profit, that is, say, your income for the business, your local SEO agency, plumber, online influencer, coach, even accountant, once you're making $100K, this is a nice magic number for me because you can afford others to help you out. You can afford considering what an S corporation may do for you as far as saving and payroll. And you can also explore other options like SEP IRAs, 401ks to defer out taxes in the future. Ultimately, you need to be deducting aggressively. Small business is the backbone of America. So take your fair share of deductions. We all know our president has, and our future presidents will. So we're entitled to spend money to make money in this country. We don't have a debtor's prison. We are here to borrow money, make things happen, get rich, and retire elsewhere. All jokes aside, take your fair share, and as you make more money, get professional help. Don't be shady. Sleep well. There's plenty to go around. Ultimately, a certain degree of paying tax, being frugal, using retirement accounts, and participating in the giant system that we all participate in, which requires often equity exposure, investing in the stock market, using debt to buy your house, and using debt to buy a car. That is the norm. If you want to go live in a Sprinter van, go ahead and email me. I'll put you in touch with my client who makes those. Number 2, should I be an LLC or S Corp? Well, like all good tax questions, that depends. You can just simply make money, get insurance to protect yourself. So you're mowing lawns, you're making 20 grand a year. Do you really need to be an LLC? Doesn't matter. So when I engage in this conversation with clients, I say, number 1, do you need to be a business entity? Who needs to be a business entity? Number 1, if you're dealing big business to big business and you're a sole proprietor, you have no legal protection, you're just operating out on your own. If you're in that state, sometimes big businesses, the military or other government contracts, they won't even deal with you. So you're already locked into being an entity. Issue with that in California and some other high-cost states, California is $800, generally speaking, just to exist. $800, you can have a lot of fun with $800. Last time I checked, if you're an interesting person. So, what do? You can start making money. You can have general liability insurance, or the step in business entity progression is, generally speaking, starting at a sole member LLC if you're by yourself. So many states and the IRS says, okay, you can be a sole proprietor, same tax system. You simply state your income and expense on your individual tax return. There's going to be a bunch of self-employment tax. Your state taxes will come in there as well. In California, that's going to cost you minimum $800 just to be a sole member LLC. But now you have this umbrella operating as a business entity. If you die, if you get sued, these are both great reasons to have this in place because it offers you a certain degree of protection. So the legal entity, although I'm not a lawyer, you got to talk to one of those people, will serve to sort of shelter your individual situation from the entity. Now, if you're an accountant and you do bad things as a business entity, you can still be individually responsible. So having your insurance in place is generally the first step regardless. Coming back to the first question I ask clients, do you need to be an entity? Do you have employees? If it's just one person operating with insurance, I've seen dentists like this as a sole proprietor, very, very successful. Does it truly make sense for you to be an entity? You have to talk to a lawyer, but it's not just a one-stop shop. Two is a crowd in business. If it's two people operating, your default legal operating entity is a partnership. And if your partner messes things up, he or she borrows money and doesn't pay it back, then they're going to look to that other partner. This is generally a pretty rotten situation to be in. Where I do see casual partners as commonplace is family owning a property. Auntie Sally and Auntie George, they own a property together and they're 50-50 and they have lots of insurance and they have a management company. Do they want to have another layer of complication with an LLC, which requires another tax return, and in California another $800? Possibly not. So, two's a crowd. Generally speaking, though, if it's a business entity and it's 5 people opening a restaurant, then hey, now you're looking at, do you want to be a C corporation? How does that operate? Do you want to be a multi-member LLC? What are the pros and cons to that? All things that we cover elsewhere. You can go back to old podcasts, et cetera, et cetera. So the answer is not easy. Now, one recommendation that is very possible is if you are just absolutely convinced that you should be an LLC and you don't know, or excuse me, any business entity, you need the legal protection, you have money to protect, you're capable of getting those filing done, paying an attorney, staying on top of those state fees, then why not start as an LLC? You can report all the income and expense on your tax return, and if and when you start to get to that $100,000 profit level, or at least $80,000, especially in California, you can start considering an S Corp to save on payroll taxes and some of the benefits that that entity can afford you. Issue with the S Corp is that while it can save money on payroll taxes, you might not have a fully solidified, solid tax position to be doing so. So you're always in a tiny bit of shady gray area. You're also required to have an entire separate tax return, which the activity of that gets reported on a K-1, and then that goes to your own individual return. So for most people, an S Corp is quite a bit complicated, and it's going to be costly. Also, payroll is going to be something that, while you're a profitable S Corp, that you'll be considering. So should you be an LLC or S Corp? It's not so easy. But when you have profits to pay for advice in this area, I highly suggest considering the different entities. And if you're in a low-cost, low-fee state, you have assets to protect, get some legal advice, and see if you want to be a legal entity. There can be some good ideas for that. In California, a lot of people get caught up in a lot of back fees, and in retrospect, they regret becoming an entity. But you never know what the heck's going to happen. Coming in hot, number 3, what is deductible? What a question! What a question. Everything except fun, entertainment, penalties, and pretty much dry cleaning, haircuts, clothing that you can wear in the street. Other than that, we're looking at ordinary and necessary things, and the commute is not allowed. You can highly recommend looking at the possibilities of a home office and see how that might make your transportation costs more deductible. Generally speaking, what I encourage clients is what not to do. So food, solo meals, out and about, and food consumed at home, just leave that off the company, leave off those personal haircuts. But when there's every shred or fraction of an idea that this thing could be a business expense, put it through the books, save the receipts, and then on a monthly or quarterly basis, you can talk with your bookkeeper and say, hey, look, this Amazon expense, what percentage is for personal purposes and what is not? So err on the side of expense that is supported with receipts, even though the IRS technically does not have receipt requirements for certain amounts. Just save them. If you're in an audit, it's going to be amazing, because if the IRS sees all these receipts from Costco, they kind of want to know, what were you buying? Generally speaking, with these audits, the IRS is rather mechanical. You're going to get a first year, third year auditor, and they want to see receipts. They want to make sure you're not being shady, following the rules. You have a mileage log, and everything has a business purpose, and you're probably going to be okay. It's those that come in with nothing and don't respect the process that get slammed really, really hard. Number 4, how and when do I pay taxes? This is not an easy question. In America, we tend to think taxes are due on April 15th. Now, the default rule for owing taxes is that you must pay as you go. The IRS calls this a pay-go system. So default, let's say you're making that $100K consistent every single year. The IRS wants that every single quarter. That means April 15th, generally, June 15th, September 15th, and then January 15th, if your income is even throughout the year. Let's take an example for some of you starting your own business out there. Let's say you have a $50,000 wage, and you've basically been paying in those taxes. You get a little refund every year. Now you start your consulting business, and first year, gosh darn, you did pretty well. You did $50,000 straight out of the gate. You had your preparation, you had your clients lined up, and you did 50 grand. The IRS is going to want that every single quarter. If you wait till April 15, then what's going to happen is that there's going to be penalty on that. Because when you're an employee, when you're earning money, that tax is being taken out. And so similarly, the rule is that you need to be paying taxes in. There are, like many, many things in tax, exceptions to that. If you go from making $100K one year, all paid in, and then you make $300K at a job elsewhere, and you're extra paid in a year of increasing income, sometimes you have an exception based upon the prior year tax. And so you can search out 90% prior year tax exception, 110%. You might have an exception when it comes to big numbers. You can explore it. Can you hold off and pay that tax April 15th without penalty? So the bigger the numbers, the bigger the penalty. Ultimately, when I work with a lot of my clients, those with the big numbers, it is important that we are paid in at the proper interval. Otherwise, it becomes a balance with, are you just going to owe a bunch on April 15th and take the penalty? And are you going to pay me or our team to calculate what you owe? So it's a little bit of a balance. You can pay taxes online. I generally suggest direct pay via the official IRS website. There are recommended ways that you can pay with a credit card or a debit card, but those are all third-party providers. So what if one of those third-party providers just disappears one day? I don't think it's worth it. I would rather pay direct on the website. 5, how do I track my expenses? Number 5. This is a phenomenally important question, and generally speaking, 4 years ago, I would say, hey, just use Excel. Do you know how to use Excel? Just give me total numbers, use the back of your napkin, whatever it happens to be, because getting into QuickBooks is just going to be a headache and you're going to screw it up. My philosophy on this has fundamentally changed. You can get QuickBooks online or equivalent. Of course, you can go to our website, accountingplay.com/links, or see if we can get you a better deal, etc., etc. But ultimately, regardless how you get it, if you're talking the most basic thing, $10, $20 a month, it is phenomenal in that you have a bank feed, meaning information from your dedicated bank account, which I highly recommend for any business endeavor, so you can track income and expense easily in one place, maybe one credit card. These transactions flow in and you literally click and accept the transactions, and those form a profit and loss or form a balance sheet, and you have a solid foundation. In these cases, the most valuable thing and time saver is work with someone who can give you some very rapid one-on-one coaching on how to utilize this tool from the onset, depending on what you have going on. So even if you pay someone 1 hour, $200 just to get you in the right direction with QuickBooks, it's incredible. Or get a monthly service with someone you trust. Tracking expenses is important for taxes. Then at the end of the year, we'll often layer on additional expenses using journal entries or direct to tax return for business mileage, sometimes home office, and other adjustments. So it's not just the books. You can actually make sure that there are other expenses getting in there. So tracking expenses becomes starting with your dedicated business bank accounts, using QuickBooks or equivalent online, starting that early because sometimes those bank feed information only lasts about 90 days, and knowing what is going on a month-to-month basis. Don't pretend like you know what's going on. Get that in there and get someone right off the bat to help you out. It is invaluable, and then you can be ahead of time going into an advisory stage versus trying to fix stuff when it's really late in the game stage. Number 6, what don't I know? What are tips to do things right? Small business owner, get yourself a separate bank account and plan now. Depending on what's going on, I understand. If you're broke, then you obviously can't afford advice. But investing in having some kind of real-time bookkeeping when you're doing consulting services, invoice through something like a QuickBooks Online, or whether it's Harvest, etc., anything that can accept a credit card, it looks professional. You can get something that wraps in engagements along with that, and it tracks it all in the same place. Use these little pieces of technology out the gate. Don't be unprofessional and casual with this stuff because it's just going to bite you in the end. So start right the first time around, educate yourself, and be ahead of schedule. Number 1, you can do a ton of things as a small business owner during the year, but once that window closes, there's only a few things that you can do after the year. So plan now. Start things off right. With the Know Your Numbers course, I always emphasize start your business while you're still making money elsewhere, because little things like the website, your social media channel, your first customer, what you're going to do, etc., this stuff takes a long time. So you might as well be thinking about that stuff when you're in that cushy desk chair rather than burning money unemployed. Number 7, how much tax will I owe? Likely more than you think if you have a profit. As mentioned, tax rates are it's not that the rates themselves continue exponential, but the first 30 grand, let's say, if you're self-employed, you'll pay very little tax. We're talking a few grand maximum. But even then you're saying, okay, 30 grand, I'm going to owe $3,000. That is something to be planned for, because 30 grand, if you have any kind of needs in your life for these things like fun or these strange things called children or husband or wife or family that you need to support, 30K is gone, and then you're 3,000 in the hole. What can happen in a typical scenario, say an independent contractor, aka business owner, that is a hairdresser, very easily, they don't do taxes for 3 years. They're living in San Francisco. They're making 60 grand. Now, 60 grand cash with no taxes in San Francisco is not bad. You can have some fun, right? Half the money, it's $30,000 to rent in a livable place, and then a couple grand for like meals, a little maybe health insurance if they're actually doing that, and it's gone. So you need to figure out get that 1 hour with someone local that you trust and pepper them with questions after you're inspired from all this stuff. Hit us up or accountingplay.com/services. See if we can throw you an hour for cheap so we can run these figures and empower you. You can go to, I know TurboTax used to have a TurboTax caster, so you can simply put in 50 grand of self-employment profit as a single filer, as a joint filer, or joint filer with kid, and see what you owe. As you get to that 50,000, 80,000 level, the taxes just get out of control. So self-employed people, they're just like, oh my gosh, why I'm paying so much tax? Well, that's because of FICA. That is your Social Security taxes. These are the things that we pay in case of a supreme disaster in life, or when you retire, you get that whopping $1,500 check each month. Who knows how that's going to be around for whatever my generation is, but that's that 15% adjusted down a little bit when you take into account the real rates and a little deduction that occurs. But if you're talking 15% off the top, even when you're making very little money, that adds up when the money's gone. So we need to have a budget for paying the tax, potentially participating in strategic accounts, any retirement accounts, paying advisors, and something to save. Worthy of noting, most people as they're going along in business, they're making little at first, and they're borrowing. They're borrowing from the bank, which comes tax-free. They're borrowing from friends. And as soon as they actually make some money, as soon as they have to pay back the bank, pay back friends, or hey, maybe take your family out to a meal because they have been supporting you this whole time, and you finally got your first big check. But unfortunately, you have to plan for the tax. And at least being ahead of schedule and projecting out during the year, you're not going to get 2 years, 3 years behind like that typical San Francisco hairdresser making 50 grand a year who's not an employee. So those are 7 questions. What questions do you have? Feel free to email john@accountingplay.com. As for the bonus, we're talking 3 success factors in business and maybe life in general. This is time, money, and energy. TME, or TEM, whatever, EMT. Time, money, energy. Anything that you're trying to accomplish in business is going to require all of these factors. And I like to mention them as this triangle because you have one that can substitute the other. So energy is extraordinarily important. With enough energy, you can build anything, do anything, but that is limited, and it's limited by our time, and money can translate to time. As they say, you can't buy time with money, but you can buy money with time. So having the right amount of money set aside, you can support yourself and go into your business endeavors. So while there's no perfect time to become self-employed, you can figure out these factors. Let's talk about the stereotypical life trajectory. Are you 20 years old? You might have a lot of time and a lot of energy, but not a lot of money. Are you 50? You might have the money and 50-50 on the time and the energy. So taking these things into account will help you plan as to when is a good time to start, how you want to start, and what is in that proverbial gas tank, which is actually much more than just the money. It is these other very, very important things. Is this business going to give you energy? Is it going to open up time for you to explore? Or is it going to absolutely drain all 3? So take them all carefully into consideration into what's going to become your runway, how long you have, how much money, time, and energy you have to make your business a success. And I want to make sure you have as much time, as much money, and as much energy as possible to succeed. Thanks. You have been listening to Accounting Play and Know Your Numbers. Check us out at accountingplay.com. And if you need a CPA, check us out at gillinghamcpa.com. Until next time.